So with that being said, since I'm a regulated guy, I got to go through the disclaimers and disclosures. So I apologize if you've heard these on multiple occasions today. But again, first and foremost, I said that we do work with Money Block and Trading Block, but we also, that's who I represent, we also have a great partnership with TradeSpoon, and specifically Vlad Karpel. Now, Vlad wasn't able to meet with us, but tradingblock.com is our website, and Vlad is the TradeSpoon founder, is also an employee of AOS, which does business as Trading Block and Money Block, which is a registered broker-dealer, FINRA, NFA, and SIPC member, and a registered investment advisor. Now, TradeSpoon and AOS are not affiliated companies, so any content that's contained in TradeSpoon is not endorsed by AOS. Now, AOS has advertising and marketing arrangements with firms such as TradeSpoon, and through those arrangements, we may form, provide some forms of compensation in exchange for marketing. Now, any content tools that are provided either by Trading Block, Money Block, or AOS that are featured in this video are for educational and informational purposes only. Any stock, option, or future symbol is displayed for illustrative purposes only and is not intended to portray a recommendation to buy, sell, or hold any security or derivative. The presenter of the video, me, Joe Cusick, and or anybody else on the team that might be participating in this video may have a financial interest in some of the securities that are presented and or the recommendations of TradeSpoon. Now, do remember that options do involve risks, may not be suitable for all investors. Take an opportunity to read and download a copy of the characteristics and risks of standardized options. You can get a copy at theoptionclearingcorp.com or Money Block or Trading Block. And if you're interested, again, in getting more information on our website, you can go to moneyblock.com or tradingblock.com to get that information. Okay, well, we got through that. Now, as you go through, as I go through today's presentation, feel free to throw in any questions, considerations. This is going to be recorded, so you're going to be able to go back and review this. We're going to go over 4 strategies. So the agenda today is looking at profitability versus probability. And what I wanted to do before I set up the 4 spreads that we're going to talk about is define first and foremost what I believe is profitability and probability. Some of you are going to have a hard time when you hear this, but I define profitability as, in my own words, defined as break even or better. The bottom line is that if you can walk away from the table and have at least the money that you walk to the table with, then I call that profitable, okay? That includes your expenses, so any commissions and so forth. And I have an exciting offer for you at the end, so please stick around. Probability, the probability for a trade to achieve break even or better. Now, you'll see that probability and profitability don't seem that far off, except for the fact that I put this term probability. Profitability is you could basically buy a stock. That's a 50-50 chance, right? When you buy an option, roughly, you're looking, you have the specific probability of success, potential success. And whether or not you're going to reach that, that's where I use probability, because that starts to help me assess whether or not I am putting the most optimal strategy in place. Because the thing about options is, and you've heard this a million times, you've probably heard it a ton of times today, options allow you to add leverage to your account. It also allows a low-cost, fixed-risk type of opportunity when you're buying options. And when you're doing strategies like the spreads that we're listing over here, you have fixed risk. And so the bottom line is that you want to make sure that you're in this game for profitability. In other words, you want to make profits. You want to make consistent profits. If you're here to hit the home run, I'm just going to be quite honest with you, and I'm always honest, but I'm just going to tell you right now, go to Vegas. You'll enjoy yourself a lot more. Because if you're one of those traders that goes out there trying to hit the 4,000% winner, and that's going to set you up, good luck. They're few and far between. You're wasting your time. So really what you want to do to increase your profitability and have that consistency, you're going to start to use probability. And that's a critical component, because if you're looking at something that has that you put very little money up and you could have huge profits, well, the probability of that actually working in your favor is very low. All right, it's a lottery ticket, and that's why you don't win as much. Okay, so let's actually go through the first of the 4 spreads that I had listed there, and we're going to look at the long bull call spread. Now, for those of you that are not spread traders, please do not go into a panic attack or shut down. I will talk about the components really quickly, but basically what I want you to understand here is that we're going to be putting on a position, okay, where we're going to be buying a call that has a lower strike price than the call that we're selling. That's a bull call spread, okay? In other words, what we're doing is we're offsetting the purchase price of the option we're buying by selling an option with a strike price higher than what I'm purchased. The reason or rationale behind that is that I don't believe, for example, that the stock is going to get above this level. So I'm going to sell that option against it, okay? Now, what strike do I pick, right? With the stock trading at $82.23, what strikes are you going to buy? What strikes are you going to sell? That is really the conundrum that most people have after they've picked a bias. In this case, I'm bullish, right? I'm bullish on this stock that's trading at 82.23. I want to utilize options to put on a fixed risk type of opportunity. Now, I'm willing to do some trade-offs here, okay? And one of the trade-offs that I might be willing to do is that I might be willing to basically trade off unlimited profit potential to the upside, right? So that I can mitigate some of my entry considerations. In other words, the actual risk that I have when I buy an option. So going back to what strike prices do I pick? Well, you can look at the option strikes. You can say, well, if the stock's trading at $82, I could look at the 90, 85, 80, or $75 calls. Remember, I'm bullish. And if I'm buying a call, that's basically you're trying to take advantage of a bullish opportunity. This is where I start utilizing probabilities. Because what's the probability? Let's say, for example, I said I want to buy the $80 calls. Right now, the bid ask is $5.90 at 6.10. I would look down at this statistical analysis of the trade and say that I would see that basically over the next 50 days, there is a 40% probability that the stock price will be above at expiration 79.82. So it's basically less than 50-50. It's actually 60-40. So there's only a 40% probability of being above 80. Okay, so if I'm buying the $80 calls, you can see that I only have a 40% probability of being right and a 60% probability of being wrong. In other words, 6 times out of 10, in theory, you're going to be wrong. Does that sound like a great opportunity? Well, I don't know. Some of you might say, well, yeah, but it's better than paying $9 for an option. All right, I'm going to pay $6 for an option, or I could pay, you know, right here, the 85s, I could pay $3.50. But the 85s may only have a 20% probability of occurring. So you start to see that if you look at it at the strike selection in terms of probability analysis, and then you go down and you look at this, basically there's only at this juncture a 40% probability of being above here, and there's only about a 20% probability of being above here, and there's only, you know, so on and so forth. You can see that there's a diminishing return, and that's why for those of you that have bought out of the money options and have lost basically, you know, 7, 8, 9 times out of 10, you now understand why. So let's mitigate that. Let's use this so that even though we could have enormous profitability with very limited risk by buying these out of the money options, let's increase our probability of success. How do you do that? All right. Well, in this case, we're going to spread off our risk, and the risk we're spreading off is taking a higher probability trade. In other words, looking at a call option that's deeper in the money. Now, when you go deeper in the money, when you're buying options, or selling options for that matter, you're going to see that you're going to get or receive a greater premium. In this case, we're going to be buying the September $75 calls for $9.80. Now, that's $980. That's a heck of a lot more money than, let's say, buying the $90 calls for $1.95, which would only be $195. But the probability of the stock being above $70 is basically around 65%. Okay, so you're looking at this at 65, 70%. You're basically looking at a high probability of this option being in the money. So what can I do to offset, though, that purchase price? In other words, get in at a lower cost basis than buying the calls outright. I'm going to sell the $90 calls against it. Now, you could even look at the $85 calls because those only have about a 20% probability. These have about a 15% probability of being in the money at expiration. So the risk reward is basically almost 1 for 1. I'm risking $785, so I've reduced my entry price by the amount of the option I sold. Great. Okay, that was one of the critical elements of this strategy or type of deployment that I wanted to meet, so I get to check that off the list. I could potentially, if the stock is at or above $90, make $715, right? And that's how much the spread will be worth. You know, it'd be worth basically the 15 bucks, right? Minus what you pay for, so you make $715 or $7.15. So you basically almost have a 1-for-1. Now, some of you might say, well, wait, Joe, you know what? What happens if the stock does pop, right? What happens? Why not look at the other side of the fence? So let's look at the cheaper, more inexpensive spread. And this time we're going to look at the $85 calls, buying those for $360 and selling the $90 calls for $1.80. Now, in this particular situation, yes, you are basically risking $1.80 or $180 to make $320. So it's almost a 2-for-1. Okay, you're risking one to potentially make two. While that's more appealing as far as risk reward or profitability, what's the probability of that actually occurring? Well, it's very low. As a matter of fact, we saw that the probability of the stock being above 80 was only 40%. The stock being above 85 was only about 20%. The stock being above 90 was about 10%. All right. The only time that I would basically look at deploying this strategy based on that probability analysis is if implied volatility was through the roof. And at this stage, I can tell just from the pricing and the probability analysis that the implied volatility is not through the roof. Okay? If the probability was through the roof, you would see, or the implied volatility, you would see that the pricing would have been skewed up. So buying, and typically when you see increased implied volatility, there's some sort of binary event on the forefront. So if you're very bullish because there's, let's say, an earnings announcement coming up during the expiration cycle of these options, well, maybe you could speculate a little bit more, but that is only if you know that that event's there. If it's just a normal part of the cycle and no binary events, you're going to probably look at this more conservative strategy where you're going to have to put up more capital, yes, but I have a higher probability of potential success versus putting up less capital. And, you know, yes, I'm giving up some profitability, right? But I have a higher probability of success, okay? So let's actually talk through that. And I apologize. This shouldn't be 40. This should be the basically if it went below 75. So I apologize. I have the wrong screen here. But let's just basically, as I had mentioned, the probability of it being, and we can actually go back to this previous screen so I can actually drill this down. The probability of it being below 76 is right around 46%. Okay, so that's just telling you that there's about a 54% probability that it's going to be above 76, right? If I'm buying the $75 calls, okay, I can tell you right now, and the stock price right now is trading at $82.50. If I'm buying the $75 calls, I first and foremost know that the calls that I'm buying are $7.50 in the money. Okay, so the stock's trading at $82.50. All right, and again, that this gives you some perspective here from that the fact is you have a ton of intrinsic value. So basically, about 2/3 of the stock, the option price, is already in the money or has intrinsic value. So if expiration was today, yeah, I bought the option for basically $9.40, but it's worth $7.50. So even if everything were to expire today, yeah, I would lose basically $2 and some change. But the long and short of it is, or right around $2, the long and short of it is, though, I have intrinsic value. So really all I need to do is have the stock go out at right around $84.50, which it has a 40% probability of going up above $80. I could actually look at this and sell, instead of the 90s, I could sell the 85s for $340. Then basically it gives me some downside so that even if the stock does pull back from 82 and some change, I own this option, which basically gives me a break even of 81. I have $1 and some change. So you can see how you can look at how to offset that so that, yes, I am paying a little bit more, but my probability of success, in other words, with this option being at 75 and the stock being at 82.50, this has roughly around a 70% probability of being in the money at expiration. When you look at that, when you look at it from that perspective, or basically almost, yeah, somewhere around 65, 70% probability, boy, I'll tell you, folks, it tends to be a better approach, especially when you don't have those events out on the forefront, like earnings and so forth. And even if earnings were there, this gives me still that higher probability of success, right? And so I look at those probabilities of either expiring below or touching. Now, the reason why I say touching, and this is something that we are incorporating on our trade analyzer tab, is because basically you are going to understand that if there's an 80% probability of touching a certain level, whether it's the low level of the spread or the upper level of the spread, that the long and short of it is that you're going to have some point where you could either take profits early and have a high probability of doing that. So let's say there was 81% probability of touching 90. I know it doesn't say that, but let's say, for example, then you would understand that, let's say I buy this spread for 7 and some change. I could go out and put an order out there to sell it at, let's say, 12. And there could be a high probability of potentially getting it out of it early. Now let's talk about a long bear put spread. And again, I know that some of this we're kind of flying through, but I want to put some concepts out there. Also, I was just mentioning some management components, like for the long spread. Let's say that you put on either one of these spreads. One thing that I'll say about debit strategies is that basically if you get, or at any point in time before expiration, about 50 to 60% of your potential profit realized, I pull the trigger on it. Unless and especially if the market, for example, let's say Coors goes from 82.5 to 85 and it does it in 2 days, I'm going to probably pull this trade off. Now, yes, you're not going to get what you would normally get if you waited until expiration as far as profits, but the point being is that when you get those binary events that happen very quickly, bottom line is that you want to go out there and you want to start taking stuff off of the table. And so one of the things that I would suggest is that from a maintenance perspective, first and foremost, if you get a 40, 50, or 60% of your profit taken in other words, it goes from, let's say, 7, basically trading at right around 11 or 12, I'm going to pull this particular strategy off. One other thing that I can suggest as far as maintenance, let's say that the stock over the next couple weeks stays at 82 and the $90 calls are trading at, like, let's say 50 cents. Or even I would say around 75 cents, 80 cents. That's where I would say this side is untested, the stock is not moving. I would look to buy back those calls and potentially roll it down to either the 87.5s if they're available or the 85s. The reason is that once I get 50% profit on this, they're going to decay, but they're going to decay pretty quickly, but not as quickly as, and you're not going to get as much offset because the stock's not moving versus going down and rolling down. So look at the untested side of the strategy and manage that if you're not ready to pull the trigger on taking profits. That's another thing that you can do. And you can take the same approach whether it's a debit strategy or a credit strategy. All right, now let's look at a long bear put spread. Stock's trading at 43.18. Now, if you look at a chart, even if you draw a support and resistance line, right? And I'm just connecting a couple of, again, I am not a technician by trade. I'm just drawing a line where you could see what once was resistance is support, and then it becomes resistance again. So first of all, when you're going to put it on a long bear put spread, what's your sentiment? You're bearish. Right now, you're not super bearish because there could be a potentially more optimal strategy, like buying puts or going short the outright, but the long or selling calls. Right? In this case, you're just saying, well, you know what? I'm bearish, and I think that it's going to stay below this level here. Right? This is what is now resistance. Let's just say it's like 43 and some change. Right? That's where the stock is trading right now. That's the decent resistance. All right. So if the stock's pulling down, I'm bearish, but not super bearish. I want to take advantage of this. So which strike price do you pick? What strategy are you going to deploy? Well, I already said I'm bearish and I want to put some sort of put strategy on. This is where, again, I could go look at the strike prices, but this is still not telling me much. Also, then I start looking at probability of touch, whether it's and expiring above or below certain levels. This is where I go in and say, well, I can't tell very much from the price action here, but I could tell a lot more here. So the probability of touching 46 with the stock trading at 43 is 55%. The probability of expiring below that level, though, is 73%. I like that. The probability of expiring above is 26. If I'm selling this, I don't like that. If I'm buying it, I like that. It gives me a higher probability of success. You can see the opposite, polar opposite is the probability of it expiring below 40 is 25%. The probability of expiring above 40 is 74%. You're starting to see how I would structure this. I want to see the probability of the option that I'm buying somewhere in this range, between 66 and 73. And I want the probability of it expiring below, I want it to be somewhere around, if I'm selling the option, around no more than 25%. If you're going to go as high as 30, know that you're going to have a high probability that it, or higher probability that it could potentially touch that level. In other words, there's a 63% probability of touching this, which in this case is not a bad thing. This means that you have a decent probability of potentially taking off a profit before expiration. That's why I always have an order working out there. So where do I side on? Do I side on putting out less money and higher profitability, right? Or do I take a higher probability for lower profitability? Let's take a look at these two strategies. One is I'm going to look at an out-of-the-money put strategy where I'm buying the $41 puts and I'm selling the $40 puts. We were talking about the two spreads, either the $1 put spread here that's out of the money, bear put spread where we're buying the 41s and selling the 40, or we're looking for the deeper in the money, higher probability put spread where we're going to buy the $46 puts. Now remember, stock was trading at around 43, selling the $40 puts to offset that purchase price. In the end of the day, when you look at the probabilities, that's really where you're going to side, especially if the environment is showing that there's a low implied volatility. You're going to start looking at these strategies. As a matter of fact, those of you that have been option sellers as your primary source of strategies, you have struggled over the last few months because vol has been cheap and the market's been directional. Yes, and I've had Killer just walk by, the king of volatility. This is where you will start to look at these deeper in the money or these in the money strategies versus doing something out of the money or the credit strategies, because of the fact that you're taking on just too much premium risk here, even though it's less premium risk when you look at it from a dollar perspective and you have the potential to have higher profitability. The thing is that your probability of being successful is lower. It's lower than this strategy, and that's really what the essence of what I want to pull out to you is that in this environment, looking at this strategy, that profitability is going to trump is going to be trumped by probability, especially when you're looking at the market and the market's having a low implied volatility. And so keep that in mind when you're looking at these types of approaches. And let me just do this. So this is where I start looking at probability of either expiring or touching. Now, one thing I can tell you is that if you know what the probability of expiring above or below a certain number, just basically double it, and that's going to be your probability of a touch. Some of you may not have access to these tools. If you don't, hey, come take a look at Trading Block. We're incorporating a lot of these components. We have them built into our trade builder. We're going to be putting them into other features and tools that we have here. But the long and short of it is that if there is a probability of expiring below 40, basically $40, 41 bucks, 43%, and a probability of touching that, well, I know that at some point in time I could have the potential to take a profit here, and there's a decent probability that I could pull down a couple bucks, but the probability of it expiring, because most of us basically oh, and you know what? The reason why there's two different prices, I have no idea. It just must have been how I built this screen when I changed it. So sorry about that, Michael. But the math still works out the same. At the end of the day, if you look at this, if there's only a 43% probability of expiring below this level, I know that I have a 57% probability that the market's going to be above there. And if there's a 39% probability of being above, I know above 42.5, which is basically my break even on this spread, I know, really, to be quite honest with you, I'm going to struggle. I'm going to struggle right here to say that this $1 out of the money put spread is going to have a high probability of being successful. I don't have any binary events like earnings or anything like that in this particular cycle, which would be September. Well, then why am I looking at this? I want something that I'm going to have a high probability of potentially making a profit. That's why I'm going to look at this one. Vol is low. The direction, the current short-term direction has been to the downside, but it has had an affinity to be hovering around that $43 mark, which is now resistance. With the stock trading at 43, if it breaks down to 41, 40, I mean, really, you have a low probability of that occurring. This is where I'm going to put, yes, more capital out, but I have a higher probability of success. You're basically, when you look at this, you're looking at roughly around a 54 or 55% probability of potential success with this, maybe a little bit more than that, maybe in that 60 range. And this, folks, is where I'm looking at this and I'm going, if I have a 60 to 65% probability of potentially being profitable, that's the strategy I'm going to gravitate towards. Especially when I'm doing spread strategies. That's the type of risk, that's the type of probability I want when I'm setting up that strategy. So anyways, now let's change gears and let's actually, I know this says long bear put spread. This should be this is going to be a short bull put spread where we're actually selling a spread. Let's actually switch this up, flip it around, and basically say, you know what, maybe we got maybe neutral to slightly bullish on this particular underlying. Again, the stock rig trading at around 43. Let's say I wanted to sell some premium, okay? And again, this is where you're going to go into probabilities. Now, the higher the probability, you're probably getting a lower return on the risk capital you're putting out there. That is just the trade-off. I want to put that out there as well, that if you have a higher probability or potential profitability built into a strategy, you're probably taking on more risk, right? But that's the balance there, folks. That's what you have to and you want to increase that win percentage, and this is how you do it. So let's actually drill down this. So stock trading at 43.18, you're looking at the option prices. You're going to go, which one am I going to sell? Well, if the stock's trading at 43, typically a lot of you would say, and this is, I'm sorry, the bear call spread, okay? This is where, excuse me, now I'm all screwed up because I had the wrong title on that strategy screen, on that slide. I apologize. This is where I'm saying I'm still bearish. But I'm not super bearish. I'm mildly bearish, and I don't believe that the stock is going to go above 43, but I don't believe that it's going to go down to 40. I want to take advantage of a market where I'm going to sell premium, and specifically I want to sell calls. So I look at the call strike prices that I would potentially look to sell, and some people will say, well, I'm going to sell the 45s or 46s. Now, I don't like to sell naked options. I mean, I'm not talking about me personally, but let's just say for this setup, I'm risk averse to selling naked options. So I want to spread it off. So I'm going to do the bear call spread where I'm going to sell a call and then buy another call above it. So I could sell the 45s and buy the 46s. So I collect 65 cents and I pay 50 cents. That means that I have a 15-cent credit on a dollar spread. One rule of thumb, by the way, folks, even though I would have a high probability that this will not, that spread will expire worthless, one rule of thumb that I have is that I want to take at least a third of the width of the spread in if I'm doing credit strategies. Meaning that I want to take in, if there's a dollar difference between what I'm selling and what I'm buying, I have to take in at least 30 to 33 cents. Okay? That's just one rule of thumb. Some people ask, well, how did you come up with that number? There's two reasons why I came up with that number. One is that means that if I do one lots or two lots, I'm going to cover the cost, or in other words, the expense of doing the trade. The commission. I know we all discussed that, and it's an important factor. And by the way, if you stick around till the end, you'll see how I'm going to be able to cut your commission costs dramatically. And my partner, Drew, would be more than happy to talk more about that with you, coming over to Money Block and Trading Block and working with us with this stuff. You could see for the probability of touching, expiring above and below, right, that your strike selection process really starts to become a lot easier if you look at it in terms of probability of either touching or expiring above, in this case because we're selling calls. And really what you're looking for here is setting up in terms of credit strategies. You want to have basically only about a 25 to tops 30% probability that the stock would be finishing above the strike price that you sold. Okay? So let's take a look at some scenarios here. All right. Let's say that I'm looking to sell the $45, $46 call spread, which means that I'm selling the 45 calls, I collect 65 cents. I buy the 46 calls because remember, I'm slightly risk averse. In other words, I don't want to take that unlimited risk to the upside. So I buy the $46 calls for 50 cents. That means that I collect 15 cents, right? That's my total profit. I know that that's my profit. Now, rule number one is I would never do this strategy because I'm only collecting 15 cents on a dollar spread. That right away gets it off my balance sheet. I can't do this strategy. So I'd either look at selling the 44s and making sure that the probabilities of it, and again, the probability of the 44s being in the money at expiration is right around 58%. That to me is getting too close to that 50-50. You know, with the stock trading at 40 bucks, $43.18, that's less than $1 away from the strike price I'm selling, which is basically saying that I only have a 58% probability of it actually expiring below that, and there's going to be an 80, a 90, almost 95% probability that it's going to touch that level. No way. I mean, it's just too high of a probability of, first of all, I'd have to sweat it out for sure, and it's too high of a probability of being in the money at expiration. Once you get into that 65 to 70% range of it being going out worthless, that's where you want to actually look to doing that strategy. Now, this also is something where instead of doing the dollar-wide strike, I could actually do the 45-47 or the 45-48. One thing that I didn't incorporate in this discussion, I went right into the in-the-money strategy because the stock has an affinity right now to be challenged to the downside. In other words, it wants, so I said I was slightly bearish, not super bearish. You could look at selling the 42s, which are in the money by $1, but I'm getting paid for that, right? And I'm going to have basically, I'm basically receiving $1.80. I'm going to have roughly right now, what is it, about 60 cents a premium in here. So it's right around what I'm selling the $45 calls for. And I'm going to buy the 46s, right, which is basically $4 above. So I actually increased the width of this so that I could have a higher credit. Yes, I'm taking on a little bit more capital risk because the width of the spread basically is dictating that I have to put up more money, but it's still less risk in terms of percentage on the capital that I could potentially, on the return I could potentially make on the profit. So you can see that I actually have a lower risk parameter if the stock were to actually go to the upside and go to 46 versus this dollar spread because I'm getting a greater return. Now the probability of it being below 42 at expiration, yes, it is lower, right? But the point being is that I do have a pretty decent risk reward here, and there is and I'm going to toggle back to this other slide. There is a 79% probability of it touching 42, and this is why I look at probability of touch. I don't just look at expiring below or expiring above. I look at this number, and the reason why I look at this number is because if in fact I sell this particular strategy for $1.80 or $1.30, excuse me, I take in $1.30. One other rule of thumb on credit spreads, right? On strategies where I'm receiving a credit for the deploying the strategy, when this is trading at 70 or 65 cents, in other words, I will have a 65-cent debit to buy this spread back. And there is a basically over a 70%, almost 80% probability that it's going to challenge this area right here of 42. I could potentially buy this back before expiration. I cut my profits at 50%. Just another nugget for you guys out there. And the probability of it potentially going, above 42 or below 42 is right around 56%, and there's a 90% probability of touching that. That's why I like that strategy a lot better. Okay? And you know what? The funny thing is that I've been talking about this. Some of you might have when I was at Options Express back. I spent 13 years there before I came over here to Money Block and Trading Block, and this is how we've been handling, talking about how to handle the maintenance of these strategies for years. And it's gotten more mainstream. I mean, we always looked at it. Before we had our probability calculators and things like that, we used it in terms of delta. In other words, we would go in and we would start looking at people and saying, you know what, if you looked at the $42 calls, right now they have basically about a 60, a 55 or 60%, 60 delta. And you're going, well, that's the probability of being in the money at expiration. Well, we wised up and said also too that that there is a probability of 90%. We just doubled that basically, tweaked it a little bit, but doubling it gives you that either delta or probability, because we're doing a spread, of touching that level. And so the bottom line is that this is how we used to have been handling the maintenance and the setup of these trades for years. We now have the tools that now will do the math, and will now, then what you do is you do the research and the statistical analysis of saying, well, how do you manage that maintenance and profitability? And it's pretty interesting to see that over the years it just has worked over all of these years. All right, let's actually go into the last spread, which is the short bull put spread. All right, now the short bull put spread is where I'm going to be selling let's say, for example, the let's say the 80 puts, and I'm going to buy the $75 puts. Okay, and so the bottom line is that I'm looking for the market to stay above the strike price that I sold. And again, you're seeing consistent theme. Where do I go? Well, after I've done some technical and fundamental analysis, and our partners at TradeSpoon, as well as here at Trading Block and Money Block, we have great resources that give you scoring, that really streamline all of that process. Basically what you could do is you could start going in and doing this analysis. And I know I stripped out some of the stuff like the probabilities, looking at the probability of being above or below. It's all part of the process. I haven't pulled up charts. I didn't even calculate the estimated moves going into these. These are all things that and events that we do. And as far as technical analysis, folks, I use some very straightforward techniques, some simple moving averages, and I may use some Fibonacci's, but for all intent and purposes, really what I use technical analysis for is I use that analysis to tell me what's been going on with the stock. I use things like implied volatility and the statistical analysis of probabilities to start helping me assess what is the forecast of potential movement in the underlying. That's why I use implied volatility. And then the other thing is, and the other side of this is that I also will use the probability analysis to make sure that I'm using the appropriate strike selection and strategy selection. So again, you see here, if I'm looking at either an in the money spread or an out of the money spread, the stock was trading at 82 and some change. You look at the probability analysis, both the probability of touching, because that gives you an opportunity to say, well, if there's a 73% probability of potentially touching 80, that means that if I did this spread right here, where I pay $9.20 and I receive $1.70 for selling the 75 puts. Well, if the stock starts to trade at a level, right around $80, I could potentially take this spread off for around $9, potentially, depending upon how fast it happens. If it happens tomorrow, I may not have that potential, but you never know. The point being is that I could have a resting order out there to basically take this debit strategy off, or this credit strategy off, at a 50% profit. Again, for this one, and for the in the money put spread, I look at this and I go, well, if there's a probability of touching 80, which would be worst case scenario, of this 73%, I might have to sweat this one out. But there's a 39% probability of it being above 80. 39% probability of expiring below. That's very low. you're talking about basically about a 61% probability of this thing going out worthless. And there's a 30% probability of being above 90. I struggle with that because, you know, here's the thing. When I look at this, I'm going, well, you know what? If I'm going to sell this, yeah, I'm getting paid a larger premium, but the bottom line is that there's a very low probability that it's going to be above this. I don't like this strategy. Now, I will look at this one. Stock's trading at 82 and some change. I'm selling the $80 puts that only have a 39% probability of expiring at that below that level, right? I received 330. Now, I'm going to cap my risk at 75. So if the stock really falls out of bed, okay. So basically, I'm sitting here going, all right, I have a $5 spread that I'm basically right now receiving about a $1.40, $1.50, excuse me, $1.60. So that fits in my wheelhouse for two reasons. One is that there's a low probability of expiring below. It does have a probability of touching, right? So I know I'm going to have to sweat that out, but I'm getting paid. And how much am I getting paid? I'm getting paid $1, roughly around $1.60, okay? That's important to understand. The reason why that's important to understand is because that's a third of the width of the spread, right? $5, it's a third of the width right there. So I'm collecting that amount. That basically means that my break even is right around that $78.40. Okay, and the probability of it being below that level at expiration or even touching is basically now you're getting into that 20% probability of expiring below, and you're getting into that like 40 to 50% probability of touching. That's your break-even point. That's a good setup. That's how I would look at this from a probabilistic strategy point, and it's also, if those of you don't look at implied volatility charts, you never really studied implied volatility, take some time to do that. But what I would say is that using this probability analysis does, say I think you should spend some time learning that. But if you haven't done that before, this analysis can really help you optimize your strategy selection, your strike selection, and so forth. All right, so I know that we moved a little fast on this. I know that I have some time, and we started about 10 minutes early in spite of the crash that we had. I said I was going to offer everybody on here an opportunity to take advantage of something. And so basically what I want to do is that I think that everybody could see this. If you can't, I apologize. But basically what this slide says is that if you come and you open up an account and start trading a trading block, I will cut your fees to $2.50 minimum and 50 cents a contract. That means that basically if you do 1 to 5 contracts, it's $2.50. All right? If you're doing a spread strategy like we discussed today, let's say you did a 4-lot spread, so you have 8 contracts, that's going to be $4. If you did a 2-lot, so that's 4 contracts total, all right, it's going to be $2.50. The other thing is that our partners at Tradespoon have also said that they have their elite program, which is all their tools and applications. And I know that Vlad has been on with Trading Pub before, so you may be familiar with his software and their tools and research. He said he was willing to cut his price to $67 a month if you're using Trading Block and you are Tradespoon subscriber. That means that you get access to all of our tools and applications. Our execution features at $2.50 minimum and 50 cents a contract, and $2.50 for stock, and a penny a share after the minimum. This blows away all our competitors, and it's all for you out there. If you are interested in that, you can always go to support at tradingblock.com. We're also, hopefully a URL is going to be posted out there for you so that you can go to our deal page. And this is where you can go in and you can actually sign up for this and open an account and then look at the opportunity at both these. So with that being said, if you have any other further questions or anything like that, please feel free. If something comes up, you have anything that you want to discuss, basically you can email me at support@tradingblock.com or support@moneyblock.com, If you're looking at it for an advisor, which is what I do as well, I am an investment advisor. You can always get in touch with me at support@tradingblock.com or support@moneyblock.com. I have 3 structured portfolios that incorporate options when appropriate. So if you're looking for an advisor that you want to work with a little bit more closely to have that support, myself and Drew, my partner, are here to help you with that. We'd love to. We have a great support desk too, as a matter of fact, very knowledgeable bunch of guys on our desk at Trading Block. So if you're looking for a self-directed experience, and like I said, we are going to be upgrading all of our feature functions with new news, new charting packages, and so forth. And you know what? I forgot to send the special link. Let me put it in there. And if there's any questions or considerations, please, 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 please feel free to just put them in there. If you have any questions about today's presentation, anything along those lines, please feel free to. And I'm actually going to put the link right here for all of you. So if you're interested, there's the link if you want to check out the deal. As a matter of fact, let's say that you do the elite service at TradeSpoon, and you basically do, if they give you 5 to 6 trading ideas, if you did basically about 5 contracts a month, 5 to 6, let's say about 5 to 6 contracts per those 5 or 6 ideas. Basically, that would cost you monthly about $30 in commissions for doing those spreads, and the TradeSpoon Elite 67. So that would cost you $97 a month. Now, if you're trading at Thinkorswim, at the new Trade Monster Option House, at Options Express or Trade King, your expenses would be far greater if you incorporate commissions, as well as the service cost for TradeSpoon Elite. I'm telling you right now, you'd be basically paying about, on average, about $70 to $80 more a month. So we're going to cut your costs. We're going to give you a great execution experience. We're partnering with a great partner in TradeSpoon, so you'll have the tools and research. We're also, we're doing a lot of new things with TradeSpoon that incorporates some of the tools and applications that we have on both sides of the fence. We are going to be putting in a new base of analytics in here too, as well on the Trading Block side. So you're really going to have an opportunity to take a look at that. So. All right, folks. If you don't have any other questions, I guess, Raleigh, I can give you the gift of time. I don't know what you're going to do now that you already had your sandwich break. Maybe it's a beer break or something.
I think what I'll do is engineer another outage here.
Yeah, that was timely. Good old Sunny. And if Sunny's on, gosh, I'll make sure to. I'll shut her down.
Well, no, and by the way, and once again, thank you so much, Joe, for your time today. I mean, that was a great presentation on spread trading the options markets, and I also appreciate your nimbleness in weathering our technical blackout. And, in all honesty here, Sonny's taken the fall for doing this, but this was 100% our fault here at Trading Pub. Sonny had logged in, and we had inadvertently given her a permission that allowed, when she exited, that she shut the room down, and that's totally our fault.
You know what?
Poor thing is going to come in here, and she's going to take the slings and arrows of the people in the room here, but that was our bad. But really, Joe, once again, thank you for working with us through that. And for all of you that were out there, that's always tough when all of a sudden the cord is yanked and you have to come back 5 minutes later and rejoin the room. So I appreciate your patience and sense of humor around that.
No worries. And hey, Mike K had a question. Mike, everything's negotiable, folks. If you want to come take a look, kick the tires, we will offer you the rate to come take a look at Trading Block. Yes, we are upgrading things. So keep that in mind when you're kicking it around. The one thing that I want to tell you is all the transactions, all of the strategies that we've discussed and the ones that you would potentially want to implement either in an IRA or a margin account or just a cash option account, you can do a trading block. We have second to none execution features. We are upgrading over the next 30 to 45 days. Like I said, our chart package, our Greek analytics, all of our analytics, our news, you're going to see a platform that is second to none, and we want your feedback. So, Mike, if you come aboard, you want to kick the tires a little bit, I'll make sure you get the rate. And anybody here, and take an opportunity to take a look at TradeSpoon as well. If you have any questions for TradeSpoon, you can always email info@tradespoon.com. That'll go straight to Vlad and his team. But kick the tires, Mike, and anyone else on here. I would love your feedback, and yes, we will give it. Everyone that's on here today, I will give that rate to. And Raleigh, I want to thank you. Yeah, before we cut off, I want to thank you and Yana for giving us a trading block an opportunity to come talk to your clients and everybody here at Traders Pub. I think it's a great day, and so I appreciate the opportunity.